Welcome to this week's Signature FD investment audio cast that we call Cutting Through the Noise, where we break down the latest market movements, key economic developments, and the big stories shaping the financial landscape. So we'll just dive right in as there's a lot going on in the markets right now. It was a mixed week in general. The S&P 500, which is a good proxy for large cap US stocks, it dropped about 1% on the week, but year to date remains up 2.8%. The Russell 2000, which is a good proxy for small cap stocks, fell 90 basis points. It's now up 2.6% year to date. International markets were stronger. Developed international markets gained 80 basis points, and now they're up 5.3% year to date, while emerging markets added 30 basis points, and they're now up 1.8% on the year. Core bonds ticked up 40 basis points, and that brings the year to date return to 0.5%. Commodities slipped 1.6%, though they're still up 2.2% on the year. And the US dollar rose 1% on the week, and it's now flat for the year. While overall market breadth did improve, sector performance was certainly mixed. Tech led the downside and is now down nearly 3% year to date, with DeepSeek acting as something of a negative catalyst last week. So, a little more on DeepSeek and AI's rapid evolution. In our newsletter this week, we discussed creative destruction, and that's the way that innovation disrupts and reshapes industries. DeepSeek raises critical questions, especially around the hardware and energy required to run high performing large language models or LLMs. AI is evolving at lightning speed, far quicker than past technological shifts like fiber optic rollout, or even when we think all the way back to the transition from horse drawn carriages. For now, we see DeepSeek as more of a shot across the bow rather than an outright game changer. Questions remain about how their models were trained, the chips that they used, and their actual innovation investment budget. But that being said, experts do acknowledge that some of DeepSeek's advancements could have real, long-lasting influence. So let's talk a little bit about tariffs and their potential impact. We're also closely watching those implications, which could take effect as early as tomorrow. Over the weekend, President Trump announced 25% tariffs on Mexican and Canadian goods. But as of this recording, the tariffs on Mexican goods have been paused for a month. 10% tariffs additionally on Chinese goods were announced. Now, Dan Clifton is one of our favorite policy analysts from Strategas, and he likens the tariff announcements to shooting the so called hostage. His research suggests that the effective tariff rate would rise about 6 percentage points, the equivalent of a 10% corporate tax hike. Now, this is 4 to 5 times larger than the 2018 2019 tariffs and could hit corporate profit margins, which are currently at record highs. Now that we have the pause on Mexican tariffs, the impact is certainly less. What's uncertain is how companies will handle cost increases of tariffs going forward. Can they pass them on to consumers? Given that real incomes have been easing, that could be challenging. If inflation expectations rise, workers may demand higher wages, adding further margin pressure. But another big unknown is, can AI driven productivity offset tariff related costs? Too often, analysts focus on one side of the equation without considering the full mosaic picture. That's why we remain cautious about making black and white calls on a market impact. Now, let's take a look at some key economic indicators. Some crucial data from the prior week. Q4 GDP growth was released, and first estimates show a 2.3% annualized growth rate, with the economy expanding 2.5% throughout 2024. And that's slightly above long term potential economic growth. Now, consumer spending jumped 4.2% annualized in the fourth quarter, and some of that may have been a pull forward ahead of potential tariffs. January consumer confidence did drop, particularly for big ticket item purchases. Now, inflation expectations, that's something to watch in the consumer survey because they did edge up, with average inflation expectations rising to 5.3% for the year ahead. So that's something that we'll keep an eye on closely. Let's turn our attention a little bit to the Fed and interest rates. The Fed held rates steady last week, adopting a wait and see approach to policy. Tariffs could make policymakers hesitant to cut rates unless economic weakness emerges. Now, we anticipate some softening as real incomes continue easing. Given the likely pull forward of spending in Q4, Q1 and Q2 might see a slowdown. For now, the Atlanta Fed's GDP Now calculation, that's tracking solid growth in January. So far, so good here in early 2025. Now, we also got data on income, spending, and inflation on Friday in the personal income and outlays report. And that showed incomes rising 0.4% and expenditures climbing 0.7%. So this reinforces that year end consumer spending surge. On the inflation front, the report came in softer than expected, with shelter costs easing. And that's a positive sign for inflation in the year ahead. Now, all of that said, we do expect some softening in economic growth, as we've said, this year, mainly because real incomes are now growing slower than average. And there is a tight relationship between consumer income and their spending. Now, turning to the fundamental outlook, expected earnings growth for the fourth quarter remains at 12%, which is important given today's stretched valuations. So, our closing thoughts on the week is that the markets had a mixed week last week and tech struggled. Tariffs introduce uncertainty, but AI and productivity gains could offset some of that impact. The economy grew steadily in 2024, but inflation expectations are creeping up. That's something to watch. The Fed is in wait and see mode here, watching for signs of economic weakening. Now, earnings remain a key focus for us given relatively high valuations, and so far, so good on that front. So that's it for this week's recap. Thanks for tuning in, and we'll be back next week with more insights. Until then, have a great week ahead.